Okay, hello folks. We are going to talk about dollar value LIFO, and we're going to do a specific example in this video. However, I want to make sure that you have watched the previous videos that I have assigned before you get to this one, because they kind of lay the groundwork for some concepts that you need to be aware of before you learn dollar value LIFO. Now, dollar value LIFO is focuses on this idea of keeping track of inventory in pools. Now, what do we mean by a pool? Well, a pool is kind of seen as a total dollar value of a group of inventory. Not the physical quantity of the goods in the inventory pool, but the total dollar value of the goods in the inventory pool. For example, let's say we have a couple of rooms, several rooms, 3 rooms in our warehouse. And let's say that in this room we have goods totaling 100,000. Okay? And in that pool of inventory there's different items, okay? But that room full of inventory is valued at $100,000. And that's just doing an inventory count and at current year prices. All right. Now let's say this room over here also has a variety of inventory in it, and let's say it's valued at $75,000. Okay. And then we have another room that is valued at $30,000. Okay. The items in this are $30,000. Again, we're looking at the total dollar value of that pool. Okay, we're not so much differentiating between physical quantities of goods. Now, the reason that we do this is this simplifies our record keeping, and it reduces the problems of LIFO liquidation and high tax bills and erratic net incomes that we discussed in that earlier video. Now, it's important to focus though on a couple things here. First of all, I want you to know we are really referring to the periodic system of inventory when we talk about inventory pools. Secondly, and this is very important, we are focusing on valuing inventory for taxes and external reporting. Okay? This dollar value LIFO that we're going to learn, this cannot be used to account internally for our inventories and making sure we don't run out, and looking at the pool of inventory we offer our customers. No, this is simply used for taxes and external reporting the dollar value of inventory that we have. This is not a useful tool for internal management of inventory. We might use FIFO or something else in regards to that. But this is when we tell the tax return or tell the financial statement readers this is what our inventory is. All right? Now, let's move on. Okay, let's work through an example here for Bismarck Company. And you can read about this in your book, and I would encourage you to do so. Now, I want you to hang with me until we are completely done with this example, because it may seem a little fuzzy at first. You might have to rewatch this video. Okay, let's say that this company, this is the first year of business, and this is going to be their base year, their first year, the year that we compare other years to. And let's say we do a physical count of inventory at end of year prices, and it amounts to $200,000. Okay, we have $200,000 worth of inventory at end of year prices. Now, we want to convert this inventory at end of year prices to, that's not what I'm looking for. We want to convert it to end of year inventory at base year prices. Now, this seems kind of silly, the first year, because the end of year prices and the base year prices, it's going to be the same because we're in the base year right now. Okay? The price index in the base year is 100. So if we divide the inventory at end of year prices of 200,000 by 100%, or 1.00, we get the inventory at the end of the year at base year prices. That seems kind of goofy. Okay, well, if that seems goofy, let's look at our next step that we have to do here. Now we take this inventory, end of inventory at base year prices, okay, and we are going to multiply it by the price index for that year. This is the base year. It's 100%, 200,000 times 100%. And now we have our ending inventory at dollar value LIFO cost, and it's 200,000. Now again, I know that seemed all kind of goofy because we are in the base year. So let's move to a year that is not the base year. Let's look at the next year of inventory. Let's look at 2012. And let's say we do a physical inventory at the end of 2012, and the inventory at the end of the year, or at end of year prices, is $299,000. Okay? Well, we look to see what the price index for this year is. And let's say that the price index is 115. Okay? Now, where do we get these price indexes? Well, the consumer price, there's something published by the Consumer Price Index or industry associations. But there's something called the Consumer Price Index for urban consumers that is very popular to use as one's price index. There's also trade associations that will publish a price index. But what they're basically telling you is how much did prices rise from this period of 2012 compared to 2011. And they're saying that prices rose 15%. All right, so you'll always be given this price index, but let's say that they were given the CPI price index, and it's 115. Now we want to convert this inventory at end of year prices to end of year inventory at base year prices. So what we have to do is we have to divide that 299,000 inventory at the end of year by 115, and we get the end of the year inventory at the base year price. All right? Now, think about what we have done here and think back to that video that you watched about the movie tickets. We have now converted this to end of inventory at base year prices. So what we have done is we have isolated the change in this account, which is going to be totally based on quantity. Let me show that to you. Okay, the change between these two numbers is $60,000. That $60,000 increase is not due to increase in prices, because by dividing by the price index, we've taken care of that. We've gotten rid of that component of the inventory increase. Okay, so we can see that inventory increased by 99,000 at end of year prices. Well, some of that was due to price increase, some of that was due to quantity increase. What we have done is isolate how much of that is due to quantity increases, $60,000. So let's move to the next step now. The next step is taken care of down here. Okay, now our inventory at base year prices, we can see, is 260 right there. Our inventory at base year prices is 260. Now we're going to divide that up into the layers. Now 200,000 of that was from 2011. And then this $60,000 increase is from 2012. That is the layer increase that we just calculated. And note that a new layer forms only when the ending inventory at base year prices exceeds the earlier inventory at base year prices. In other words, when the quantity increases. So we take this quantity increase for 2012, and we're going to multiply only that layer by the price index of 115. or 1.15. So once we do that, we have that layer that we computed, and now we have this layer that we computed. Our ending inventory at dollar value LIFO cost would now be $269,000. This is the amount of inventory that we report on our financial statements and in our tax return. Okay. I know it's kind of tricky, but if you watch this video, you'll see that the numerical mechanics of this is really not that bad. Let's look at the next year now. Let's look at 2013. And let's say we take inventory at the end of the year, and at the end of the year prices, and it's $300,000 worth. Okay? Well, we're told that the price index is 120 from 2013 to 2011. In other words, they're saying 2013 prices are 20% higher than 2011 prices. And again, this might be the CPI, this might be from a trade association journal or whatever. So what we're going to do is the same methodology. We're going to take that inventory at year-end prices divided by the price index of 120% or 1.20, and we are going to get the end of year inventory at the base year prices. Now look what has happened here. We actually have a decrease here, don't we? We have a decrease. Once again, we have gotten rid of the price change component, and we have isolated this to a quantity change. And this 260 to 250, that is a $10,000 change, not due at all to prices, but simply due to a change in quantity. So let's see how we're going to deal with that. Okay, well, let me thumb down here. All right, let me do that so we can see this. Okay, I'm going to keep the previous work that we did right there. Okay, but now let's focus on that section. Whoops, this section right here. Okay, all right. So our inventory at our end of year inventory at base year prices is $250,000. Now let's construct that as far as layers. Okay, we have our 2011 layer from previous, but now we have a $10,000 decline. So what we do is that was 60 minus 10,000. That 2012 layer is now at 50,000. When we have a decrease like this, it does not form a new layer, but it rather decreases the previous layer. Okay, so we have this 50,000. That's the layer at base year prices. Okay, this 250 here equals the 250 there. Now what we do is we multiply those amounts times the applicable price index. Once again, this is times 100%. And we multiply this not by 1.20, but by the 1.15, because we did not create a new layer. We are still dealing with 2012 layers. Okay. Once again, a new layer forms only when the ending inventory at base year prices is greater than the beginning inventory at base year prices. Okay, so this is how we convert our inventory to what its amount would be for dollar value LIFO, and that is the amount of inventory right there that we'd report on our tax return and on our financial statements. All right. Okay, let's go a little further. All right, let's take a look at 2014. 2014. We do an inventory at the end of the year at end of year prices, and we get 351,000. Now we're told that the price index for that year is 130%. So we divide 350 by 130%, and we get 270,000. Okay, now let's look at the change again here. All right. Okay, the change between these two numbers now is 20,000. Okay, we have accounted for, or we have neutralized the price change in that amount, and so this is all a quantity change. And as I said, a new layer is going to form since that quantity changed. So let's look to see what we're going to do down here. Okay, let me shrink this row. So let's focus on this section down here. Okay. All right. Well, what is our inventory at base year prices? It's 270,000. Now let's put that into different layers. Well, we have this original base year layer of 200,000 times 100% equals 200,000. Up here we had the 50,000 times 115% equals 57.5. But now we have $20,000. We're going to create a new layer. Well, that occurred in 2014. That $20,000 is going to be shown right there, and we're going to take it times the price index for 2014 of 130%. We only take that 130% times that layer of quantity change that we isolated up here, and we get 26,000. 20,000 times 130% is 26,000. If we add those up, our total inventory at dollar value LIFO cost will be 283,000. Okay, you following me? You know, if nothing else, just kind of focus on the mechanics of all of this, and when you do your examples. And I think some of the rationale behind it will kind of come as you do the mechanics. All right. Now, one thing I want to make sure that you focus on is make sure that this value right here, let me highlight it in yellow, is always equal to that value that's showing right there, the inventory at the base year prices. Okay, and that's also showing right there. Okay, I'll do it with a different color here. This number here needs to equal that number right there, which is that number right there. Okay, but all we are doing is converting our inventory into a dollar value LIFO cost inventory. This is what would be reported on the financial statements and the tax return. This is not used for internal management of inventory, but simply for those other items. Now, we're going to do some examples for homework, and as you work through the mechanics of this, I think you're going to find it a lot easier. But watch this video again, and you might look through the example in the book as well, which this is based on, and hopefully this will help you. And of course, if you have any questions, you can always ask me. Thanks. Bye.